Hey folks, welcome back to Master Plan Retirement's Retirement Roadmap. My name is Evan, and with me as always, retirement planner Mark Fricks. Today we're going to be talking about end-of-year tax deadlines for retirees. Often when we hear the term tax deadline, we think of April 15th. But once you retire, your tax deadline has shifted in most cases to December 31st. We're slowly entering fall, and now is the perfect time to make sure your strategies are in place for closing out your tax year.
I think you need to stop using that word tax. That may have to
We're going to lose some listeners.
May have to blip that out a little bit.
Well, it's actually everyone's favorite topic and least favorite topic.
I think that's true. It's almost like a political word.
Absolutely, absolutely.
Yeah, both opposing forces coming against each other. But it is important to talk about because being proactive can make such a difference in your tax bill now. Also, though, in your tax bill in the future, into retirement as well. And as if you're a listener to our show very much, you know we talk a lot about taxes because it is such a critical part of planning and life itself. So I think today's show is really going to be helpful. Hopefully you're in a spot you can take notes, not in your car, or come back and watch the podcast or listen to the podcast later on the masterplanretire.com website. But it is an important topic, and I think you'll get a lot out of it today.
Yeah, and each of these points that we go through, you know, it's not just to do this, step by step. These are items to strategize with, to plan with, because as you know, we are holistic retirement planners, meaning if you make a change in one place, it's going to affect other areas of your retirement. So you really have to create a holistic, all-encompassing retirement plan and make sure everything works together. And that goes for your tax strategy. And we're not tax reporting. We're not reporting history like we're filing every year. We're thinking 10, 20, 30 years down the road. What's our tax strategy in retirement? How does that affect our income, our legacy, our asset growth, so many things.
Today also we're talking about taxes this year as well, which we don't do as often. A lot of times we are talking about what is your tax bracket going to be in retirement, but I think a lot of today is going to cover, can you lower your taxes this year, and next year. So I think that's what makes today's episode a little bit different, I think.
Yeah, so December 31st tax deadlines. Number one, required minimum distribution. So Uncle Sam is knocking. The tax bill you've been deferring for 50 years has come due. RMD ages have been complicated over the last few years. Secure Act and Secure Act 2.0, these acts shifted the starting age from 70 and a half to 72, 73, or 75 based on your year of birth. You must take your first RMD by December 31st of the year you hit that age, and by December 31st of every subsequent year.
Except the first year.
Except the first year.
That's right.
And this is an interesting exception because in that first year, you're allowed to delay your distribution until April 1st of the following year. So for example, if I hit 73 this year, I could delay my distribution until April 1st, 2025. But here's the catch. I'd have to take another distribution by December 31st, 2025. So I'm taking 2 RMDs in 1 year, 2025. That doesn't always make sense, especially when you consider you're going to be taxed at your bracket on those 2 RMDs, and those withdrawals increase your taxable income.
Right, so 2 RMDs in 1 year is kind of what we're narrowing these down to. And so what is the problem with that? As you said, 2 RMDs adds to your taxes, could put you in a higher tax bracket, unless there's a special circumstance that year, right? Maybe you're not working that year, maybe you got laid off, or maybe you retired and you haven't turned on other income, you need that for income. Maybe a Social Security kicks in the next year, so this year that RMD becomes something you live on. So there are exceptions. Again, we're coming back to the holistic, planning, but typically you want to go ahead and take that RMD the year you turn 73.
And just as I said earlier, a change in one place can affect a couple of other spots. If you start taking more withdrawals from your IRAs than you were planning to, that could affect your Social Security, your Medicare, things like that.
Right. And something else I guess you could look at is Roth conversions and how that may affect it. You also have to look at IRMA, which we may be talking about later today, maybe not, but
not
IRMA
specifically, but go ahead.
Yeah, so IRMA is if you based on how much money you make on Medicare Part B, it could raise your premium. So if you take 2 RMDs in 1 year, it could also raise your Medicare Part B premium. A lot of people don't realize that, so that's something else you have to look at as well. So again, there's a lot of layers to this, but that's why we spend so much time with our clients Not creating a plan and putting it on automatic pilot, but more about meeting once, twice a year. Also phone calls, emails with different strategies. Maybe it's time to shift gears on Roth conversions. We know there's a possible tax increase coming. I think we'll talk about that here shortly as well, perhaps. But so we got to take that into account as well.
Yeah.
So in 2 years, we think we'll be in a higher tax bracket, whether unless Congress acts, of course.
Yeah. So with RMDs, it's the same as with all retirement planning. A strategy should be in place long before your first RMD to maximize the efficiency of your withdrawals. Number 2, as you mentioned just a moment ago, Roth conversions. So we've said it before. Taxes are currently on sale. We have until December 31st, 2025 to remain at our current tax brackets until the 2017 tax cuts sunset. Okay, so we know that these could be extended. It's possible. But we don't know, and that's not something we can really rely on. Politically charged as our country is, and as convoluted as politics tend to be, I don't know how quickly that would move through Congress for them to hang on to it. I mean, we do know that tax laws are written in pencil. They can change, but it's getting everyone on board to actually finalize the change.
Yeah, and we concentrate so much on the presidential election, which could have a bearing on that change or not being changed, that sunset. But you also have to consider Congress. We've got congressional seats up. We've had, I can't remember how many congressional people have retired over the last few months and coming up at the end of the year. So those are seats that have to be filled as well. So there's going to be a lot of new people coming, and so they can have a major effect on, can they extend the sunset, or can they abolish the sunset? Can they do even more tax cuts, or is it going to just get worse down the road? We lean toward it getting worse, only because of the fact that we are 34-point-something trillion in debt. Social Security is in trouble. Medicare is in trouble. We tend to have a political system now to where folks want to get elected by promising to give more stuff away.
Yeah, we're spending more and more, and we're not optimizing the systems that are already in place and trying to getting rid of some of that waste. It's frustrating, to say the least. But why? How does saying that taxes are on sale affect Roth conversions specifically? And that's because when you convert IRA money to a Roth, however much, the tax bill on that is your tax bracket. So if you're in a lower tax bracket and you convert that year, it's probably a good year to convert. Maybe you didn't earn as much income that year. You're going to be paying less taxes on that Roth conversion. That's what we mean. While our brackets are still kind of low, or historically low, not kind of low, our historically low tax brackets right now.
Right.
While we're still in that phase, it's a really good time to think about conversions.
Well, just like a client meeting I had last night, part of the discussion, probably 30 minutes of the discussion, was about Roth conversions, because again, the clock is ticking. We have this tax year and we have next tax year, and so they wanted to be a little more aggressive. So we looked at their tax bracket, we looked at how much income was coming in that we knew about, and we said, where's the next bracket? Well, the next bracket was only 2% more, and so they said, we don't mind that, so let's get further into the 24% bracket. And so it comes down to how you feel about taxes. It comes down to what you believe is going to happen to taxes in the future. There's so many things that come into play, and so we have to have that conversation, and then the numbers come into play as well. And so we're going to meet again in November just to make sure they didn't have to take money out of an IRA or something between now and then. But we'll meet in November, come up with that final figure of how much we want to convert and pull the trigger on it and go ahead and pay the taxes on that money, never to pay again. I mean, a Roth is a beautiful vehicle. It grows tax-free, and you're never taxed on the money coming out. Even your children and grandchildren that may inherit that Roth, when it comes out, which they do have to take it out, but it's not taxable, so there's not a tax burden on them either. So while taxes are low, like you said, what can we convert? How much can we convert? As you know, Evan, we've got a few clients that are super aggressive. They're trying to get all money out of IRA, and I'm not opposed to that, but you've got to have that mentality that I don't want the IRS to have any control over my retirement.
And again, those conversions are going to affect other things in your retirement as well. It is considered income for the year.
Right. So it's a great time if you're under age 65 and not on Medicare Part B, or maybe you still have a job on group health. It's not going to affect your Medicare Part B. You don't have to have that become part of the conversation. But if you're 67, 68, and you do a 100,000 conversion, you've just raised your Medicare Part B premium maybe 2 levels at that point. And they, a couple for a couple, that could be $700-800 a month, just Medicare Part B premium. So again, that has to come into play. I know we talked about this earlier, but it's all part of that approach of looking at that to maximize the rest of your retirement.
Yeah, and again, seeking a financial professional, preferably a fiduciary, retirement planner, help plan this conversion strategy. And again, not being so afraid of the next tax bracket either, because we have a progressive tax system. Again, if you're in the 22% tax bracket and you're just barely getting into 24 if you make that conversion, so it's really the last few dollars that are being taxed at 24%, it might still really be worth it for you. So strategize. There's a lot of fine planning within that.
Yeah, and we even try to come up with what your real tax rate is, because even if you're in the 20% or 22% bracket, that doesn't mean you're paying 22% taxes, as Evan said, on all of your money, just on that last part that's in that next bracket. So your first little bit of money is 0, then 10 and 12 and so forth and so on. So what is your real tax rate? Many times your CPA can tell you that. If they're not telling you, you need to ask them, but we also have a chart that helps us come up with that number as well. So what are you really paying, and would you be paying on that little extra that you may be converting?
That's right.
Good point.
Number 3, deadline for December 31st, realizing losses and gains. Towards the end of the year, for those investing in the market, you'll begin to know which stocks are winners and losers, what's grown and what has dropped. The silver lining is that you can realize some of those losses. This will help offset the gains from all those winners you picked. This is also known as tax loss harvesting.
Yeah, so it's a very low amount of money you can deduct on taxes on losses. I think it's $3,000 per year or something like that. And you can carry that forward. If you had a $10,000 loss, you can carry that over the next 3 to 4 years. But if you have something else that has a big gain and you want to further diversify, or you feel like it's time to get out of that particular holding, whether it be a fund, a stock, anything outside of an IRA, then you can take that gain of $10,000, and then you got a loser over here of $10,000. You have no capital gains, and so you're good. And so we have a spreadsheet we developed that's called a gain loss report, and it will tell us exactly which your gains, which your losses, what is the total, and we start choosing which ones to sell and which ones to get rid of, move it to cash, and then even if we can buy it back again after so many days if we want to. Is it 30 days? I think we can buy it back, if I remember correctly.
Yeah, I think it's 30 days.
Yeah, if you love the stock, buy it back, but you got rid of that big gain. Now pick it back up and let it start growing again if you think it's a winner. So again, very strategic. It is so many moving parts. I can't imagine people that go into retirement with any amount of money that just kind of take the drive in retirement. There's so many things they can do.
You can't set it and forget it.
To maximize and to make everything more efficient. If you're afraid you're going to run out of money, then all of these things need to be looked at. Plus the fact that we need an income plan to show you if you're going to run out of money and make sure you don't run out of money. And then you've got the heir, your legacy. Do you want to leave something to kids, grandkids? A lot of our clients, probably half of them, say, I'm going to spend as much as I can. They're fine, they're good, they're educated, we helped them, and that's fine. But at the same time, I'd rather my kids get it than the IRS.
Yeah.
So I still want to maximize, what's going to our heirs as opposed to the government, which I love my government, the IRS not so much, but the government does have a problem with spending and not spending wisely. If they would fix that, I would feel a little bit better about my tax bill.
Yeah, absolutely.
Website, masterplanretire.com.
Should
remind them about
Retire.com. We usually like to do a smoother segue, but sometimes we'll just go straight for it.
Just blast it out.
Masterplanretire.com. Check out our website. You can schedule your complimentary consultation to discuss your own retirement, have a series of reports ran for you. Get a real 10,000-foot view of your own retirement. Just as Mark said, as important as an income plan is, we can actually take where you are now, turn on your retirement, stress test it, see where your strengths and weaknesses are. All of that is complimentary. Multiple resources on our website as well. These episodes are available there, webinars and seminars. So you can join us online in a webinar for multiple retirement topics, or seminars if we come to your town. What else? Retirement checklist. There's a lot of resources.
There's a neat little green button. to schedule a meeting.
Yep.
And our calendar pops right up, and you get to choose a time that's convenient for you, whether it's by Zoom, whether it's face-to-face, phone call, for that initial chat, just to kind of find out your feelings, your thoughts, your goals, your needs, your dreams, and then the next meeting would be taking information from you, nothing super personal, some basic information so we can run those reports to really say, if taxes go up, am I going to run out of money? If I lose a spouse, am I going to run out of money? If inflation increases, if all these different ifs, what ifs, and then if we find out that yes, that's going to cause you to run out of money, we fix it. Right? We have a strategy for it. So, by the way, you can also reach us by telephone, 770-980-9262, and schedule something as well. Or just, shoot us an email if you got some basic questions, info@masterplanretire.com. And I'll be glad to, or Evan will be glad to reply back to you with some little basic questions or whatever. And also there's a link on the email you can schedule as well. So, info@masterplanretire.com or the website masterplanretire.com.
Yeah, Mark, you mentioned where do we want to leave our assets? Some people aren't as concerned about leaving a legacy to their heirs, but do we want to leave that to our heirs or Uncle Sam? Well, number 4 is concerning charitable giving. So with the doubling of the standard deduction under the Tax Cuts and Jobs Act, also known as the Trump tax cuts from 2017, very few retirees itemize deductions these days. However, that does not mean there isn't any tax benefit to giving. If you are of RMD age, you can realize a tax benefit by giving directly from your IRA. Regardless of age, you can give multiple years at once using a donor-advised fund to get above the standard deduction. You can also give shares of appreciated stock to avoid capital gains. Regardless of the strategy you use to give, the deadline for all charitable giving is December 31st.
So let's dig into that a little bit. So let's talk about the QCD, the Qualified Charitable Distribution. So let's say your RMD is, you have to take out $20,000 this year, and you really don't need it. You've got other good income sources, you've got other things going on, so you're fine, but you're going to have to pay the tax on that regardless. If you do it correctly and you need help with this, believe me, get help with this, okay? You can send that RMD amount or part of the RMD amount directly to a charitable organization. It could be a church, it could be, the Humane Society, anything that you support. If you tithe at church, you can do it all at one time for the whole year. But that
you can do it systematically as well.
Exactly. And so that means that $20,000 or whatever does not show up in your tax bill. Okay, so you're not taxed. You can actually, Evan, I don't know if you knew this or not, you can actually do it starting at 70 and a half.
No,
it doesn't have to be RMD. So you can start at 70 and a half doing a qualified charitable distribution. So, which I don't know why they didn't change that to match the RMD law, but it's 70 and a half or older, and you got a bigger IRA, and you're just like, hey, I want to give to my charity. You can, again, give it directly to the charity. Again, it's got to be done with a form. The check can't come to you. It can't go from you to the church or you to the Humane Society or whatever. So make sure you do it correctly.
Yeah,
so,
that's a great option.
It really is.
And you don't have to do the entire RMD, as you mentioned. Maybe you do need some of that RMD, or you just want to chip away a little bit more at your tax bill for that year. You can give some of it to a charitable organization.
Exactly. Yeah. Now, you mentioned a couple other topics in that. What was something else you mentioned besides QCD?
Just that there are fewer items to deduct these days, but it doesn't mean that there's not a benefit to giving. You can give multiple years at once using a donor-advised fund.
Yeah, that's a complicated subject, and we won't cover it in today's show, but it is a fund to where you can give over a certain amount of time and get the amount large enough over a period of 3, 4, or 5 years so that now you do get a deduction on it because it's above that exemption of $29,000 plus this year. Now, if the 2017 tax cuts expire at the end of next year, then those deductions become easier to take because the exemption is much lower. But so again, just some smart moves to help now, help later, whenever whatever applies in your life and your age and what's going on.
Well, and something else that we don't hear much, people don't consider very often, is non-qualified money. You can also give shares of appreciated stock.
That was the other thing you said I wanted to mention. Absolutely. So a lot of people don't know this, is that, so let's say I bought Microsoft years ago and I paid $10,000 and it's worth $40,000. If I sold it, I'd owe tax taxes on $30,000 capital gains. If I give that stock to my church or my charity, I don't get a tax deduction, but when they sell it, they actually I do get a tax deduction if it's above my exemption, okay? But if they sell it, of course, they don't pay taxes because they're a charitable organization. So it's a way of getting rid of those high capital gains, them getting, again, a gift that could help them. So ask us about that if that's something, if you've got a lot of, we got a couple of clients that have huge capital gains in some stocks they bought years ago and they just held them to them. And they're like, how do I get out of these? Well, you could die. So if you leave capital gains to an heir, they don't pay taxes on those capital gains. That's a plan, okay? But if you'd rather not wait till you die, that's one way to do that, to make sure you...
It's pretty slick. Don't liquidate and donate the cash. Donate the stock itself, and then you're not liquidating. They liquidate it. They get the. They don't pay taxes on it.
That's right.
Pretty sweet.
Yep.
Number 5, rollovers take advantage of IRA, RMD aggregation, and QCDs. This one doesn't make most of the December 31st list. However, it's important if you want to simplify RMDs in retirement. IRAs generally allow for aggregation for RMD purposes. However, 401ks, other employer-sponsored plans do not. So here's an example. If you have $2 million across 3 IRAs and 1 401k, you calculate your total RMD to be $80,000. You can take the IRA portion from any of the IRAs. However, the portion from the 401k must come separately from that account based on that balance. If your money was in 4 IRAs rather, you'd be able to take just 1 RMD from any of the accounts. Not only does this simplify the process, but it allows you to defer distributions on accounts where the investments are down that year.
So a couple of comments on that real quick. So first of all, that's a good reason to get that 401k. That's reason number 5, to get that 401k out of the 401k into a personal IRA, better control, more investment options, but also you don't have to worry about an RMD on that account only. So Evan's example was great. $2 million in IRA money, $80,000 you've got to take out. You don't have to take out from every account. As he mentioned, you can, let's say you've got one account that's way up. You might want to take it out of that one as opposed to taking it out of one that's down that you're pulling principal out. And so you can take, part of it here, part of it there, half of it here, all of it there. You have a better opportunity to be more strategic. There's that word again. More strategic about where your money's coming from. So just be very careful. RMDs can be dangerous if you don't do it correctly. You can pay penalties. You can get messed up. So we track all of our clients' RMDs to make sure that they're getting them correctly. Some are automated, but a lot of them we try to be, again, very strategic about where we take them from as well.
Yeah, and as mentioned in the QCD section that we discussed, you can give money directly from your IRA to a charity via the QCD. You can't do this from an employer-sponsored plan such as a 401k or 457b. So if you want to be able to do this in 2025 or aggregate all of your accounts so that all of your RMDs can be associated under one aggregate total, you got to do this before December 31st of 2024 in order for it to qualify for 2025 RMDs.
Correct. Yeah. And again, another reason to roll over a 401k, I think we've had a show about that before, but you're just much more limited with a 401k and you kind of lose partial control of it. And it's also, if you leave your 401k at an old employer, if that employer goes bankrupt or something, you could be in trouble with the 401k as well.
Yeah, what happens if you need the money? A lot of 401ks have rules on how many withdrawals you can make in a year. There's just a lot less freedom, a lot less access to the world of investments.
Yeah, your investments are so limited. You're limited primarily to just a handful of mutual funds. And mutual funds, as we've talked about before, are very archaic. So again, good reason to do that.
Those are your retirement tax deadlines, December 31st. Any last words, Mark?
I hope you enjoyed the show, and until we see each other again, remember to plan well and prosper. Take care, everybody.
This was Retirement Roadmap Radio with Mark Fricks of Master Plan Retirement Consultants. To schedule a complimentary consultation, go to masterplanretire.com or call 770-980-9262. Thanks for listening, and remember, Plan well and prosper.
All matters discussed during this show are for informational purposes only. Each individual situation may vary, and the opinions expressed here may not apply to everyone. Materials presented are believed to be from reliable sources, and no representations can be made as to its accuracy. All ideas and information should be discussed in detail with one of our qualified representatives prior to implementation. Advisory services offered through Master Plan Retirement Consultants, a registered investment advisor in the state of Georgia. Mark Fricks and Master Plan Retirement Consultants are not affiliated with or endorsed by the Social Security Administration or any other government agency.